Imagine you've spent years building this multi-million-dollar business. Right. You sell a really effective, innovative personal safety device.
Yeah, and people love it.
Exactly. Consumers absolutely love it. You're riding high. Your sales eventually hit this impressive, like, $118 million for the year.
That's a huge milestone.
It is. But then suddenly the machinery just starts grinding. Your profits start to just vanish.
Right.
Your warehouses are suddenly overflowing with, millions of dollars of unsold parts, and all those tens of thousands of people visiting your website every single day. They're just suddenly leaving without buying a single thing. So, what do you do?
Well, that's really the ultimate test of leadership.
Welcome to today's deep dive, everyone, because today is really a masterclass in business turnarounds.
Yeah.
We are looking at a company trying to fix a very, very messy financial engine while they are, still mid-flight.
And honestly, it's one thing to invent a great product. It's an entirely different beast to transition that product from being this niche sort of early adopter favorite into a massive mainstream consumer staple.
Without bankrupting yourself in the process, of course.
Exactly, without going bankrupt.
And for you listening, we actually have the perfect paper trail to analyze how that transition happens. Our entire discussion today is built on a very revealing stack of financial documents from Byrna Technologies.
That's ticker symbol BYRN on the NASDAQ for anyone keeping track.
Right, DYRN. We are pulling directly from their Q1 2026 earnings report. So that's the press release, the raw financial tables, and most importantly, the actual transcript of their April 9th earnings call.
Which is such a gold mine.
It really is. That call features their brand new CEO, Conn Davis, and he is just taking the helm to explain the path forward.
And it's incredibly candid material, honestly. When leadership changes, you usually get this brief window where the new CEO is very willing to openly discuss all the structural flaws of the company.
Before they become his fault.
Precisely. Before those flaws officially become their own fault.
Yeah.
So Conn Davis is laying it all out there.
We are definitely going to dig into all those flaws. But before we get to the spreadsheets, let's just quickly establish exactly what Byrna makes, because it's totally central to this whole story.
Yeah, that context is key.
Their core product is a kinetic launcher. So if you haven't seen one, it looks somewhat similar to a traditional handgun, but the mechanics are completely different.
Very different.
It's powered by compressed CO2, and it shoots non-lethal projectiles. We are talking about hard kinetic rounds meant to deter an attacker, or like pepper balls that burst into a chemical cloud on impact.
Right. So to be clear, it doesn't use gunpowder.
No gunpowder. It doesn't shoot bullets. And generally, you do not need a background check to buy one. They basically carved out this brand new category of accessible, less lethal self-defense.
A category that clearly has a massive audience.
But
the financial results for the first quarter of 2026, they reveal this profound paradox in how the company is actually operating.
That paradox is exactly where we need to start. Because on the surface, if you just glance at the top-line revenue, Byrna looks like a company that is just absolutely winning.
Oh, totally. Top line looks great.
Right. In Q1, their net revenue hit $29.05 million. That is a solid 11% increase compared to the exact same time last year.
Which means more money is coming through the front door.
Exactly. But the second you look at the underlying financial health, the warning lights are just flashing red everywhere.
Yeah, the top line shows consumer demand is there, but the bottom line shows severe operational bloat.
It is bleeding. So despite bringing in almost $30 million in revenue, their actual net income just plummeted to a mere $0.8 million.
Wow.
Yeah. For context, that is down from $1.7 million a year ago, so they cut it in half. We also see their adjusted EBITDA drop to $2.2 million from $3 million.
And we should probably quickly define adjusted EBITDA for anyone who doesn't spend their weekends reading corporate balance sheets.
Please do.
It basically stands for earnings before interest, taxes, depreciation, and amortization.
Quite the mouthful.
Yeah, it is. But simply put, it is just a way to measure the raw operational cash profit of the core business before all the accountants step in to apply tax structures and write-offs.
Got it.
So when EBITDA is dropping while revenue is rising, it means your basic business operations are just getting way more expensive and a lot less efficient.
And to make matters worse, they completely missed Wall Street's consensus earnings per share.
Right, the market's scorecard for profit per share.
Exactly.
Yeah.
Analysts expected them to hit 8 cents a share, and they came in at just 3 cents. Plus, their cash on hand dwindled down to $9.6 million.
Which is getting uncomfortably low.
Very. But here is the number that absolutely jumps off the page. Their inventory is sitting at a staggering $33.1 million.
Yeah, that specific number is the anchor dragging down the entire balance sheet right now.
Okay, let's unpack this, because to me, this sounds exactly like a wildly popular restaurant.
Okay, I like where this is going.
You know, there's a line out the door every single night. The dining room is just packed with paying customers. But somehow, at the end of the month, the owner realizes they are barely breaking even.
Right.
Why? Because the kitchen is a complete disaster. They have like 3 times as many line cooks as they actually need. There is 0 portion control, and they bought these massive pallets of really expensive ingredients that are just sitting in the walk-in freezer going bad.
Just rotting away.
Exactly. The revenue is there, but the operational chaos in the back is eating every dime of profit.
That is a perfect visualization. You have incredibly high demand at the front of the house, but terrible efficiency in the back. And what's fascinating here is how the new CEO, Conn Davis, addresses this head-on.
He doesn't try to hide it at all.
Not at all. He isn't trying to spin it. You know, he took over from the retiring CEO and founder, Brian Gantz, and Gantz did an incredible job taking the company from 0 to $118 million in sales.
Truly impressive growth.
Absolutely. But Davis openly recognizes that the aggressive, the entrepreneurial skill set needed to build a brand, it's totally different from the disciplined skill set you need to optimize a supply chain.
Of course.
He points directly to that $33.1 million inventory and just frames it as trapped capital.
I am really curious about the mechanics of that bloat, though. I mean, how does a company accidentally end up with $33 million of extra stuff just sitting in a warehouse?
Well, it usually happens during a phase of hypergrowth combined with external panic.
Panic.
Yeah. During their massive expansion over the last couple of years, the previous management was terrified of stockouts.
Yeah.
I mean, if you don't have parts, you obviously can't sell launchers.
Right.
Add in the lingering chaos of global supply chain disruptions that everyone was dealing with, and the company basically just overordered everything.
Oh, I see.
They bought massive surpluses of plastic housings, microchips, internal valves, just to be safe. Now, the supply chain is stabilized, but all their liquid cash is frozen in those physical parts, sitting on shelves.
And you cannot spend circuit boards on new marketing campaigns.
Exactly. You can't pay employees in plastic housings.
Which naturally leads us to figure out how they actually plan to sell through that massive pile of inventory. To understand the bottleneck there, we have to look at the absolute front door of their business.
Right.
We have to look at their flagship website, Byrna.com.
Digital storefront, which is currently undergoing a pretty major identity crisis.
A severe crisis. The conversion numbers on the website have basically fallen off a cliff.
Yeah, it's bad.
Back in May of last year, the conversion rate was about 1.17%. But by March of 2026, that conversion rate plummeted to just 0.54%.
Wow.
It was essentially cut in half.
That is a catastrophic drop for any e-commerce platform.
But wait, the obvious assumption here would be that people just lost interest, right? Like they just stopped visiting the website.
Right, that traffic dried up.
But the data from the earnings call shows the exact opposite. The average daily sessions remain incredibly stable. Throughout early 2026, they were seeing between 34,500 and 40,000 people visiting the site every single day.
So the traffic hasn't vanished at all.
Not at all. The foot traffic is massive, but nobody is pulling out their credit card.
Furthermore, when people do make a purchase, the average order value is actually down significantly.
Yeah, because the returning customers are only coming back to buy ammunition.
Right.
They're buying like extra CO2 cartridges or pepper balls for the launchers they already own. They are not buying the new high-margin devices.
Right. They're just restocking.
Exactly. Even Byrna's newest release, the CLXL model, is severely underperforming online. Conn Davis admitted on the call that the website simply fails to explain why a customer should spend the extra money to upgrade to it.
Which brings us to the fundamental flaw in their entire digital strategy. And it's deeply psychological.
Okay, break that down for me. What is the actual disconnect between those 40,000 daily visitors and the product itself?
So Davis identified the core issue as being too, quote-unquote, weapon first.
Weapon first.
Yeah. Historically, Byrna marketed to tactical enthusiasts, self-defense experts, and people who already own traditional firearms. And those consumers, They love dark, gritty, aggressive branding.
The sort of tactical aesthetic.
Exactly. But today, the person clicking on Byrna.com is very different. It is a 20-something college student who just wants to feel safe walking to her car at night.
Right.
Or it's a suburban parent who jogs at 5 a.m. and wants protection from aggressive stray dogs. So when those everyday consumers land on a homepage that is just covered in tactical SWAT team-style imagery, there's a massive psychological friction.
They feel intimidated.
Very intimidated. They assume, this isn't for me, this is for a security guard, and they just immediately close the tab.
Okay, but hold on. I have to push back here.
Sure.
If you have almost 40,000 people a day visiting your website, and you are sitting on this massive $33 million mountain of bloated inventory, plus your cash reserves have dwindled down to $9.6 million.
Yeah.
Don't you kind of have a fiduciary duty to just liquidate? Like, why not run a massive 40% off flash sale? Just slash prices, clear the warehouse, and put cash in the bank to keep the lights on?
Oh, man. It is incredibly tempting for a CEO to pull that lever.
It has to be.
It is. But it would actually be a long-term disaster. Because if a consumer genuinely does not understand what your product is, or, like we said, they feel intimidated by it, making it $20 cheaper does not suddenly compel them to buy it.
Oh, that makes total sense.
Pricing is not the barrier. Education is the barrier. If you slash prices, you just cheapen the perceived value of the brand, and you still haven't solved the core problem. They have to shift the psychological framing from, this is a dangerous weapon to this is an everyday safety device.
So how do you actually execute that shift digitally? Like, how do you hold the customer's hand without a salesperson actually being there?
By entirely removing the burden of research from the consumer.
Yeah.
Byrna recently launched this Find the Right Launcher interactive quiz right on their homepage. And instead of just throwing specs and jargon at the visitor, the quiz asks really simple lifestyle questions. Like, where do you live? What are your safety concerns? Are you keeping this in a nightstand or are you carrying it on a hike? And based on those answers, it curates a specific, personalized recommendation.
And the initial data on that quiz is pretty wild, honestly. They've already generated over 30,000 responses.
Wow.
And the people who complete that quiz, they are converting at double the rate of the overall website.
It's a huge.
Yeah.
Because the quiz completely eliminates the intimidation factor. It transforms this complex, scary gadget into a personalized safety solution.
They are also entirely revamping their influencer strategy, too.
Oh, really?
Yeah. They're moving marketing dollars away from strictly tactical, gun-focused content creators and instead partnering with broader lifestyle influencers just to normalize the product.
That's a smart mode. However, fixing a digital identity takes time. Rebuilding a website and changing an entire marketing narrative, that is a very slow ship to turn. But there is a silver lining here.
What's that?
There's one specific arena where that consumer education is actually happening effortlessly. And it is driving massive volume.
Yes. We are talking about the physical world.
Exactly.
Brick-and-mortar retail is proving to be the ultimate remedy for their digital struggles. The contrast between how they perform online versus how they perform in physical stores is just staggering.
It changes the entire dynamic of the sale.
Byrna is aggressively expanding their physical footprint right now. I mean, they entered 2026 with roughly 1,500 total retail locations.
Okay.
And they are pushing hard to hit 2,000 locations by the end of the year.
And we should note, these are not just small, independent, mom-and-pop sporting goods shops.
Not at all. These are major national rollouts.
Right.
They are partnering with Academy Sports and Outdoors, starting with 50 stores in Q2 and targeting up to 250 by year-end.
That's massive.
They're also moving into Murdoch's Ranch and Home Supply, starting at 14 locations and targeting 30. But, the sheer volume of stores isn't even the most compelling part of this retail strategy.
Really? What is?
The real genius is in the merchandising, specifically where the product actually sits inside the store.
Oh, placement is everything in retail.
Take Bass Pro Shops, for example.
Okay.
Historically, Byrna launchers were placed behind the glass in the traditional firearms section. So if you want to look at one, you literally have to track down an employee, ask them to unlock the case, and handle it under supervision.
Which is a huge barrier.
Exactly.
Yeah.
Now they are negotiating to move the launchers out of those glass cases and onto high-traffic end caps.
Oh, wow.
Yeah, those freestanding promotional displays at the very end of an aisle.
If we connect this to the bigger picture, moving from behind a glass to an open-end cap, it fundamentally rewires consumer psychology.
How?
Think about it. When a product is locked in a glass case next to hunting rifles and shotguns, the consumer's brain subconsciously categorizes it as a restricted, dangerous weapon.
Right.
It requires this background check mentality just to even ask about it. But when that same product sits freely on an end cap next to, say, camping lanterns or running shoes or Yeti coolers,
Yeah.
the context completely shifts. You can just pick up the box yourself. You can read the back. It has essentially been normalized into an accessible consumer gadget.
Here's where it gets really interesting.
Okay.
To me, this dynamic is exactly like trying to buy a high-end mattress or like a virtual reality headset.
Oh, I see.
You know, you can read all the technical specs online, you can watch video reviews all day,
Sure.
but until you physically put that VR headset on or actually lay down on the mattress, you hesitate to spend the money.
Totally.
But the second you pick up a Byrna launcher, you feel the weight and you see how simple the mechanics actually are. The intimidation just vanishes and the purchase decision happens almost instantly.
Yeah, physical interaction bridges the education gap way faster than any website ever could.
And Conn Davis brought the data to back that up on the call.
Oh, you did?
Yes. In retail stores that feature dedicated shooting experiences, meaning stores that have a small actual physical range where customers can fire the launcher into a target, they generate roughly 3 times the sales volume of non-experienced stores.
3 times the sales volume. That's incredible.
Tripling your revenue simply by letting the customer pull the trigger.
Yeah, in Byrna's own company-owned retail locations, those higher margin, really expensive CL and CLXL launchers, the ones that are totally failing to sell online.
Yeah.
In the physical stores, they make up almost 80% of total sales.
80%.
Right. Because once a customer can physically hold both models side by side, they immediately understand the value of the upgrade.
It proves definitively that the core product is not broken at all. They just have an education problem, not a manufacturing problem.
Exactly.
When the product is placed in an environment that encourages discovery, it basically sells itself.
Absolutely.
But, you know, building out all those in-store shooting ranges and securing prime end cap real estate, that is a brilliant strategy for the future.
It is.
But it takes an incredible amount of time, negotiation, and capital. And that brings us to the harsh reality of what is going to happen to Byrna's financials over the next few months.
Oh, yes.
Because the transition period is going to be brutal.
Turnarounds always look the ugliest right before they start working.
Q2 of 2026 is going to look rough on paper. Davis was brutally honest on the earnings call, explicitly warning investors that the upcoming quarter is developing materially below their expectations.
Right.
They are facing some incredibly tough year-over-year comparisons.
Can you explain what makes the comparisons so difficult for them this year?
Sure. So last year, during the second quarter, they launched a major new launcher model. And when you launch a new product into retail chains, you get something called a retail load-in order. That is the massive initial bulk order a chain, like Academy Sports places, just to stock the shelves and back rooms of hundreds of stores all at once.
Right, getting it in the system.
Exactly. Last year, that initial load-in surge generated $2.7 million in a single quarter.
Yeah.
This year, without a major new launch in that specific window, they're only projecting about $300,000 in load-in orders.
Ouch.
Yeah, that is a massive revenue hole to fill.
And because of that impending volatility, management actually announced a significant change in how they communicate with Wall Street.
Yes, they did.
It's something that day traders absolutely despise, but turnaround specialists love.
They're completely stopping the practice of pre-announcing their quarterly revenue.
Which is huge. When a leadership team constantly pre-announces revenue, they're basically playing this dangerous game of feeding the beast.
Chasing the stock price.
Exactly. You end up making short-term, sometimes really irrational business decisions just to manage the stock price week to week. By stopping that practice, Conn Davis is sending a very clear signal to the market. We are putting our heads down to fix the underlying machinery of this business, and we are not going to be distracted by short-term stock fluctuations.
And we are already seeing those operational fixes take place right now. To burn through that $33.1 million in bloated inventory, they are making some really tough calls at their main manufacturing plant in Fort Wayne.
What kind of call?
They are deliberately reducing their build rates and actually cutting headcount on the assembly line.
Wow. But it is basic financial hygiene. You have to stop the bleeding before the patient can heal.
I like to think of this strategy like a controlled burn in forestry.
Oh, that's a great analogy.
If you have a massive forest filled with years of dead, dry underbrush, which in this case is their $33 million in excess inventory, you are at constant risk of a catastrophic wildfire that could just destroy the entire ecosystem.
Right.
By deliberately slowing down production, cutting costs, and basically taking a painful hit on Wall Street now, Conn Davis is lighting a controlled fire. It looks destructive, the air gets smoky, and investors might panic in the short term. But it safely clears out the dead wood so the sales team can empty the warehouse, ensuring the company actually has healthy soil to grow sustainably next season.
And beyond just clearing out the warehouse, they're also engineering their way out of future high costs.
Oh, so?
Davis announced they are developing a next-generation modular launcher platform that's slated for early 2027.
Okay, break down the mechanics of what a modular platform actually does for their bottom line.
So right now, different models of launchers require unique internal parts, custom valves, specific screws, all that.
Sounds complicated.
It is. A modular system means standardizing the internal guts of the device.
Ah,
You create a universal internal chassis that can simply be dropped into different exterior shells. For the assembly line workers in Fort Wayne, this is revolutionary.
I bet.
They aren't spending time painstakingly putting together highly complex, unique mechanisms for every single product variation. The parts just snap together faster, the total component count drops, labor costs plummet, and the profit margin on every single unit goes up while maintaining the exact same quality.
So what does this all mean? Are they basically hitting the pause button on their explosive, headline-grabbing growth just to clean house and standardize parts?
This raises an important question about the life cycle of a modern business, honestly.
Okay.
There is a very real existential danger in something called unprofitable growth.
Unprofitable growth.
Yeah, you can grow your top-line revenue to the moon, but if your inventory is ballooning, your free cash flow is draining, and your margins are shrinking, you will eventually collapse into your own weight.
Just run out of cash.
Exactly. Conn Davis explicitly stated he is targeting mid-teens free cash flow. And free cash flow is the actual usable money left over that you can put in the bank after running and maintaining the business.
Which is the most important metric.
It really is.
Yeah.
He also noted that all capital allocation will be focused purely on perfecting this core launcher business, rather than getting distracted by, say, expensive acquisitions into connected software or tangential markets.
Focus is good.
This is the absolute hallmark of a company maturing. They are deliberately trading that explosive, messy growth for sustainable, profitable growth.
It is a fascinating pivot to watch unfold in real time. We are observing a company that successfully created an entirely new category of less lethal personal defense.
And they rode that initial wave of enthusiastic early adopters to $118 million in sales.
Right. But the tactics that got them to that milestone are completely different from the tactics required to cross the chasm to the mainstream consumer.
And we've definitely seen the blueprint today
Yeah.
for how they actually plan to cross that chasm.
We really have. They are battling those plummeting online conversions by fundamentally pivoting their digital messaging, moving away from intimidating tactical weapons and toward everyday safety solutions with personalized quizzes.
Now leaning heavily into experiential physical retail.
Yes, moving products out from behind glass cases and onto accessible end caps so customers can physically interact with them. And most importantly, they're willing to endure a painful financial quarter and take the heat from Wall Street to optimize a bloated supply chain and build a highly profitable modular future.
It serves as a powerful reminder for you listening that having a groundbreaking product is really only half the equation.
Exactly.
How you frame that product to the consumer and the physical context of where you place it in a store changes everything about its perceived value.
So whether you are an investor analyzing a stock, a founder trying to scale your own operations, or just someone fascinated by consumer psychology, Byrna is providing a perfect real-time case study in the mechanics of a brand turnaround.
It's a textbook example.
It is. And before we wrap up, I want to leave you with one final lingering thought to just mull over.
Let's hear it.
If Conn Davis's strategy actually works, if Byrna succeeds in completely normalizing the idea of less lethal self-defense for the everyday suburban family, Could we see a near future where having a kinetic launcher in your home is as common and as totally uncontroversial as keeping a fire extinguisher under the kitchen sink or a standard first aid kit in the hallway closet?
That would completely redefine the baseline of what home safety looks like for the average
And
person.
it really would. Thank you so much for joining us as we explore the engine room of Byrna Technologies. Keep asking the right questions, and we will catch you on the next deep dive.